Welcome everybody to our webinar about the Main Street Lending Program. Just before we start, I do want to let you know that we are having really bad storms out here. And if for some reason I disappear in the middle of this, I sincerely apologize. It wasn't anything you said, it was the Wi-Fi didn't take kindly to the weather. Please post your questions in the Q&A only. A recording of this webinar and slides will be posted shortly on our community site at realtime.inc.com. And later in the day, we will also be emailing a copy to the participants. Briefly about myself, I am the founder and CEO of MultiFunding. I'm an Inc. columnist. I've advised the prior administrations as well as the Federal Reserve on the business credit markets. I have a book out called The Growth Dilemma, and for my entrepreneur organization friends, I'm a proud member of EO Philadelphia. My lawyers asked me to share some disclaimers. We are in an unprecedented time in history, and the information available to us is changing rapidly. Please refer to our most current presentation for education. The information provided is based upon our best judgment about what to know at this time. However, key questions remain about how to implement this program. MultiFunding LLC does not accept any liability as it relates to the timeliness or content of the information we are sharing today or may share in the future, and we are under no legal duty to update any such information or recommendations. We encourage you to check in with your attorneys, CPAs, and financial advisors for additional insights. This is the time for us to be thinking about what is next for our business, to reimagining what we look like. Are we going to pivot 5%, 50%, or 90%? What will our team look like going forward? Who will be our key players? And what ammunition will we need for this battle? And in this context, ammunition is cash. And we will need cash for both offensive and defensive purposes. How much cash will be required to get your business back up on a stable footing? What is the best case and the worst case scenario? Now, have you thought about where this cash will come from? And what does your future look like, and what opportunities do you want to take advantage of? These are the veins I'd like you to think about the Main Street Lending Program, which is $600 billion allocated towards it as part of the CARES Act. It is in effect until December 31st, 2020, and it is comprised of 3 facilities, the new, a priority, and an expanded. Let's put some context around this because there is a good amount of confusion. The Main Street program is not an entitlement program like PPP. These are loans, they're hard to get, they will be underwritten like loans, and you'll have to pay them back. If your business has been badly hit by COVID-19, your best chance for a Main Street loan will be through your existing bank. It's going to be difficult to get a new lender to give a very hardly hit business a Main Street loan. And if you plan to use a Main Street loan to expand and grow, more banks will be open to you. The program is live. It's off to a slow start, but it's getting going. Most participating banks are starting to get up and running and underwriting files. The Federal Reserve has issued a list of lenders on their website that is not 100% complete or accurate, and the program has been extended until December 31st. It's important to understand the motivation of lenders who don't stand to make a lot of money on these loans. If you have an existing lender that you have a bunch of debt with, and they are able to issue you a loan, that makes a lot of sense for them because it protects their current liability. But if you need to go to a new lender, they're really going to look for credits that are doing well or have done well in COVID-19. And there are approximately, to the best of my knowledge, 400 lenders participating in the program. To be eligible, your business must be established prior to March 13th, 2020. If you have more than 15,000 employees or more than $5 billion of revenue, you're too big, and you have to be created or organized in the United States. That means that at least 50% of your assets must be in the United States, and your net income generated in the United States, and annual net operating revenues are generated in the United States. Subsidiaries of foreign companies can apply as long as they attest that they will not send their money abroad to their parent. Eligible entities are partnerships, LLCs, corporations, associations, trusts, cooperatives, joint ventures with no more than 49% participation by foreign business entities or tribal business concerns. Sole proprietors are not eligible to apply. Nonprofits are eligible, but through different program rules. If you're a developer or landlord or lender, you're not eligible, and certain other industries, such as the sex industry, are not eligible. How do the affiliation rules work with this loan program? If you own a couple different companies, you have to think about them all together, and the companies as a whole can only apply for one type of Main Street loan and cannot exceed the maximum loan amount for that facility. There are 3 loan programs, the new, the priority, and the expanded. And let's start with the new and the priority that share some commonalities. These are secured or unsecured term loans. They have a 5-year maturity. You pay nothing, you pay no payments in year 1, interest payments start in year 2, at the end of year 3, you pay 15%, at the end of year 4, you pay 15%, and the end of year 5, you pay a balloon of 70%. They are written at current LIBOR of 3.18 to 3.31%, LIBOR plus 3. You can prepay without penalty, and the fees to get in are now 2% in almost all cases. How do you determine the loan size that you are eligible for? The new facility loans are for $250,000 to $35 million. So let's figure it out. They are 4 times your 2019 EBITDA minus your existing debt. So if you take in row 3 a company with $500,000 of 2019 EBITDA, the maximum they could get would be 4 times that, or $2 million. If that company's existing debt was $1.5 million, their potential new money loan would be $500,000. That same company in row 1, if their existing debt was $500,000, their potential new money would be $1.5 million. Now, what happens here is if you have other lenders and you get the Main Street lending program, how do the lenders coincide with each other? In case of bankruptcy, the new lender must have the same rights as your other lenders except for your mortgage. However, in the normal course of business, the old lender's rights can be senior to your new Main Street new lender. These loans can be secured or unsecured, depending upon what you work out with your lender. Priority facilities are bigger. They also start at $250,000, but they go as high as $50 million. So how do you calculate these? These can go as high as 6 times your 2019 EBITDA instead of 4. So if you take row 3, a company with $500,000 of EBITDA, they could be eligible for a Main Street of $3 million. That company already had existing debt of $1.5 million. They could get a potential priority money loan of $1.5 million. That same company in row 1 had $500,000 worth of existing debt. They could get a potential priority money loan of $2.5 million. What's unique about these loans is that you can refinance your debt inside of them as long as it is not with the lender that you're getting the loan with. And these loans, the lender's rights have to be senior or on par with all other lenders. And they can be secured or unsecured depending upon what you work out with your lender. The expanded facilities are bigger. They go from $10 million to $300 million. So to take as an example, in row 2, a company of $10 million of 2019 EBITDA, the maximum expanded facility they could get would be $60 million. If that company had existing debt of $50 million, they could get a potential new money loan of $10 million. These loans are quite similar to the other facilities, except the rights tag along with the rights of the existing lender, and the fees to get in are a little bit smaller. For all of these loans, unless you're refinancing debt into a priority facility at the onset, you cannot use the proceeds of the loans to pay off other debt early, reduce principal balance, etc. And you cannot, while you have the loan, seek to reduce or cancel your current lines of credit. That you also have to certify that you have reasonable basis to believe that your business will not go bankrupt in the next 3 years. next 3 months. I'm sorry. While you have the loan, you can repay a line of credit or including a credit card in the ordinary use of business. You can take on additional debt obligations as long as they do not conflict with the rights of your Main Street lender, and you can refinance maturing debt. You can commit to certain compensation, stock repurchase, and capital distribution restrictions while you have the loan. There are exceptions for tax pass-through entities in order to pay your taxes. While you have the loan and for up to 12 months after the loan, you agree not to repurchase an equity security that is listed on the National Securities Exchange of the eligible business. And you agree not to pay dividends or make other capital distributions with respect to the common stock of your business. There are limits on compensation. For those who earn between $425,000 and $3 million in 2019, your compensation is capped at that while you have the loan in 1 year thereafter. For those who earn more than $3 million, say you earned 6, what you do is you take the difference between 3 and 6, which is 1.5, you add it to the 3 and you got $4.5 million. You commit to make all reasonable efforts to retain your employees while you have the loan. However, they are much less stringent requirements like the PPP. And your lender will calculate your EBITDA. If it is a lender that has lent you historically, they will calculate your EBITDA and any proposed adjustments the exact way they've done it before. If it is a new lender, they will have to calculate your EBITDA the way they've done it for similar companies like yours before. Your debt will be calculated on the date of your application and will include all existing outstanding and undrawn available debt from private and non-private lenders. This will include, if you have an asset-based line that's secured by accounts receivable and inventory, the amount that will be included is the amount you've actually drawn against the line, not the amount that you could borrow. How do you pick between the three? Well, let's take a look at a company with $4 million of EBITDA and $10 million worth of existing debt. They could get a new facility for 6, a priority facility for 14, or an expanded facility 14, and they would have to decide which one made the most sense for them. Financing strategy is like playing offense and defense. So I want to share with you some case studies that people are using this program for. One is a company with a $3 million line of credit and $1 million drawn. They're planning on getting an MSLP for liquidity. They would rather not draw down their entire line. Example number 2 is a professional services firm whose partners will reduce draws by at least 50% in 2020 to recover from COVID-19. They plan to take an MSLP to spread their income hit over 4 years instead of 1. And example number 3 is a company that has already been approached by several competitors who plan to close shop. They plan to acquire companies at pennies on the dollar and use the MSLP money to help. How much cash will be required to get your business back on a stable footing? What is the best case and the worst case scenario? And where will the cash come from? And how will you fund it? And what does your future look like? And on what opportunities do you want to take advantage of? These are the questions, and now it's my pleasure to open up the questions in the Q&A, and we'll be happy to take whatever we can. Let's begin.
Thank you, Ami. Can we use the MSLP funds for purchasing assets to grow? In other words, can we use the money for acquisition of companies who are struggling in COVID times?
There's no reason that you cannot do that.
Can MSLP funds be used for growth via acquisition of smaller companies?
Yes, that's permitted.
My company has some amount as bill factoring. Will that be considered as existing debt?
I'm not exactly sure. It depends what that contract looks like.
Refinancing of funds raised by bill factoring is allowed for using MSL monies, to clarify?
Again, I'm not sure if you're talking about bill factoring or invoice factoring. If you're factoring invoices, that should be a debt that can be refinanced.
I've called a number of lenders that are participating in the MSLP, and every one of them tried to talk to me out of this loan program and steer me to an existing SBA, as it is less restrictive with better loans. Any thoughts?
And we're often having a very similar conversation depending on the situation. An existing SBA can make a lot more sense. It just depends on how much money you're looking for, the size, how your business is doing, and that often is a legitimate conversation to have.
Purchasing of assets for growth purposes is allowed as per my knowledge, but purchasing equity in other companies is not allowed. How is this related to acquisition of any company?
If you're using the money off of your EBITDA of your existing company and you have it, you can then do whatever you want with it, as long as you're not using it to refinance other debt.
I've heard that the feds are considering a new SBA loan alternative to the MSLP. Do you know anything about this?
And that would be music to my ears and wonderful music to my ears, but I haven't heard anything about it. Happy to take any other questions, folks. Questions going once. Questions are going twice. Feel free to jump in with any questions. All right, you can feel free to email us at, and yeah, we have one more.
Will the lenders want to know exactly how we'll spend the money?
They definitely want to have it, not to the penny, but a good use of proceeds and what your plan is. We're happy to take any other questions. Questions going once.
How can your firm help? What size companies do you work with?
We are working with borrowers. The minimum loan amount we're working on is $2 million. We're having a very tough time getting loans done underneath that amount right now, and happy to discuss that with you offline if you want to. Any other questions? Questions going once? Questions going twice? I'm sorry, there's a question that I don't understand.
It looks like it was entered mid-question.
Yeah, we'll give it a minute.
If the funds
can be used for acquisition, correct? Okay, everybody. We wish everybody well. Good luck out there, and if there's anything we can do to help, please let us know. Take care for now. Bye-bye.
Thank you.